Assalamualaikum warahmatullah. Welcome back again to Sada Education. So we will further examine the time value of money in Islamic finance, and we will do that by looking at the dalil in fiqh muamalat, and we have earlier shown that the early scholar have no disagreement regarding the determination of credit price. So credit price can be set above cash price, and that will only hold for sale and purchase transaction. And therefore, when we look at the legality of profit in Islamic banking, the fact that the profit is acquired from deferment, in the sense that if you look at the sale price, is equal to the facility amount plus the profit margin. And the profit margin is basically the profit derived from the deferment, and the facility amount would be the cost price, and the total payment, which is the debt, that would be the credit price. And therefore, the credit price is more than the cash price, and this is lawful from the standpoint of Shariah, and that have to be based on a sale price. So I was saying earlier that the sale must qualify the following requirement, that the sale must evidence the transfer of ownership from the selling party to the buying party, and before making the sale, the selling party faces ownership risk, because the selling party is the legal owner of the goods, and therefore the seller is bound to face ownership risk. And this ownership risk can cause the price of the good to fall. When there is a market downturn, price will go down, and this will incur loss to the selling party, right? So the idea is for the sale transaction to face ownership risk, based on the legal maxim al-ghurum bi-ghunni al-kharaj bi-daman, that the selling party invested his money in the business, and the capital is subjected to appreciation and depreciation based on market forces. And this is the morality of sale, as opposed to riba, where the profit from riba is determined by contract and not by the market movement. Therefore, when we see that the lawful profit from murabaha, or from deferred payment, must be based on sale, and therefore the time value of money, meaning that the time preference, the positive time preference, is permissible as long as the transaction is based on a sale. But it is based on a loan, then surely the justification for the charging of interest from loan is not acceptable in Islam. If we look at the comparison here between the increment in loan and the increment in murabaha financing, right? So in the conventional loan, the increment is coming from money lending, whereas in a murabaha, the increment is coming from a sale, because murabaha is a sale, and therefore the increment is coming from a different entity. Murabaha is coming from a sale, and conventional loan is coming from a lending and borrowing transaction. So these are two different transactions. Number two, from a loan, there is no underlying asset. So there is no subject matter involved in a loan, because a loan is only is just a money lending activity, exchanging of money for more money, or exchanging money for less money. Whereas in murabaha, it is a sale, and therefore there is an underlying asset. So there is an object or subject matter or al-mal. So these are two different situations in a loan and in a murabaha. So, but then when it comes to the profit in a loan is declared upfront. So meaning that when we look at the in a conventional loan, when the profit rate is set at 10% with a facility of 10 million, and the interest margin would be 10 million multiplied by 10% multiplied by 5, that will be 5 million. So the amount of interest charge is determined upfront in the loan contract. So in the loan contract, when we do the signaging, we will see that the interest charge is set upfront. It is been contracted upfront, leading to the debt to be higher than the loan by virtue of the interest margin added onto the loan. So we have debt more than the loan over here. And when we look at the increment in murabaha, the profit is also declared upfront. If the facility is 10 million and profit rate at 10% and tenure of 5 years, so the profit margin is also equal to 5 million. That is a 10 million facility multiplied by 10% profit rate times 5 years. So that will be 5 million. And we see that in the murabaha agreement, when we sign the letter of offer, we know basically how much we owe the bank. On the day when we sign the letter of offer, the profit has been stated in the contract, which is 5 million. And therefore the debt we owe the bank will consist of the cost price and the profit margin of 5 million, and therefore the total sale price is 15 million, right? And that is the debt we owe the bank. So debt will be equal to 10 million, which is the facility amount, and 5 million, that is the profit margin. And that profit margin is stated upfront, like the interest margin that was stated upfront. So these are the two similar property in loan and murabaha. And then we see that the increment in the loan is contractual in nature, right? So when we look at the interest charge is 5 million, and when we sign the agreement, the loan agreement, it is stated that the debt we owe the bank is equal to the sum of loan plus interest, and therefore the interest charge is a contractual agreement, is a contractual amount that the borrowing party must pay up over the duration of the payment. Likewise, when we look at murabaha or tawarruk, we can see that the profit margin of 5 million is a contractual amount that has been declared as the selling price, consisting of the facility amount of 10 million plus the 5 million profit, and therefore the profit rate, the profit margin is declared upfront, similar to the interest margin in a conventional loan that was declared upfront. And the increment in the loan is set by the lending party. Yes, meaning that the bank will set how much they would charge us, from the loan. And the same happens in murabaha, that the bank will be the one setting the amount of profit from the sale. So the increment, which is the profit margin, is set by the selling party, which is the bank. So we have similarity between conventional loan and murabaha. And then the increment in conventional loan is due to time value of money, meaning that there is positive time preference. Because of that, the fact that postponement of current consumption or current spending must be compensated with extra payment, which is interest, but that is coming from a loan transaction, and therefore it would not be allowable in Islam. But basically the justification is time value of money. And for the murabaha financing, the increment can also be explained from TVM, meaning that the reason for charging profit margin is because of the fact that the bank is unable to collect payment on the spot, and therefore the deferred payment would cause the bank not being able to reinvest the money that they should be getting from the sale, and that opportunity loss should be compensated. So that positive time preference can also be used in Islamic banking. But as long as the murabaha is based on a sale, and it fulfills the entire requirement of a sale, including ownership risk, and therefore we should be able to allow the use of the abstinence and ague theory to justify the profit charges of Islamic bank. But this component of TVM is quite delicate. I do expect that we should work on this matter a lot more to just clean it up, so that we can clearly make a distinction between the TVM in murabaha and TVM in loan. And lastly, of course, murabaha is a business transaction, and loan is a business transaction. So there is a big similarity over here, and therefore we can see that from the 7 property, 3 property or 3 points are quite different, and the rest are similar, and therefore the position of Islamic transaction on TVM can be further enriched if we were to further examine the theory of interest. If the scholar can come up with a theory of profit margin, or the theory of profit rate in Islam, or the theory of profit rate in Islamic finance, then because profit rate here will be dealing with profit rate in murabaha, or profit rate in debt financing, or the theory of profit rate in debt financing, that would be a very good landmark or achievement in Islamic finance, if there is some people who can come up to justify or explain the theory of profit rate in debt financing in Islamic finance. Inshallah, we do hope that some work can be done on this area. Okay, thank you very much. Inshallah, we will see again to further discuss this important issue. Please don't forget to share and subscribe and to comment. Thank you. Assalamualaikum.